I'll move pretty quick. I'll probably touch on 5 or 6 different stocks under coverage, and if there's any questions, happy to talk throughout the day. So that's just the coverage there. Obviously, REA is reported, but the bulk sort of start about next week. And so at the top right chart's just basically using the COVID low as a baseline for the 3 classified plays, REA, SEEK, and Carsales versus ASX 200 and the NASDAQ Tech Index. Obviously, they've all sort of derated with the broader tech sector pullback, but in recent periods, they look to have been making a pretty decent recovery. So, on a 3-month view, the larger quality free cash flow generators, REA and Car, predominantly have sort of outperformed. But probably what's interesting is, in more recent times, the market looks to be taking another look at some of these smaller tech players with cash on balance sheet. So those that, are going to look to survive the next 12 months without a raise, and, Airtasker and Redbubble clearly have cash on balance sheet and looks like they've caught a bid in the last sort of month or so. So just off looking at the multiples, that sort of top left-hand chart, actually, I've pulled down the short interests in the top 3 stocks, Car, REA, and SEEK. Interestingly, they've actually been closing coming into the result. Car came down from about 3% to about 1%. So people clearly hedging their risks coming into the result, expecting a pretty strong outcome, I can tell. And on that, you see the Carsales is probably 1.5 times, so 1.5 points above its 5-year EBITDA average. Caught a bit into the result, and REA SEEK still trading under their 5-year averages. But I mean, I guess what I can say about the multiples themselves is you get a pretty small chance, pretty short opportunity to actually get into these high quality names when they pull back, because they tend to find some pretty decent valuation support, and the market obviously has a look at that and bids them up. I know I spoke about REA yesterday, but I just thought I'd pull down these charts from the actual investor presentation, which was quite interesting, and just sort of pointed out what I was talking to yesterday. The listings growth by quarter, and that top right hand was what I mentioned, how we start to cycle some of these stronger comps coming into FY23, and that's probably something to be mindful of. And just under that, we've got the house price growth, which has actually slowed. You'd see, house prices growth has peeled right back actually to about 9%, with units at about 6%. So what that probably highlights is, obviously that hot market where people were going through some of these off-market transactions. Some of those will be hopefully coming back onto the platform, and underpin at least some of that volume growth into 23, albeit to a lesser extent. And as I touched on yesterday, the Premier penetration and that depth of growth is actually quite strong in REA. You can see, the Premier penetration as a percentage of depth has actually continued to grow. And that Premier Plus product that they're rolling out and have monetized since the 1st of July is expected to underpin that double-digit yield growth into 23. So just a couple interesting charts I thought that highlighted what I was talking about yesterday. Carsales, as you might remember, they exercised the call option to buy the remaining 51% stake in Trader Interactive. They paid and raised 1.2 billion for it. At the time, I thought it was quite a full multiple. They paid about 21 times 4Q22 annualized EBITDA, while trading on about 18 times at that point in time. But look, it might be a full multiple, but to me, the rationale, the strategic rationale behind that acquisition, bringing it all in-house made sense. They're basically going to be rolling out the Carsales product suite into that digitally immature market, and hopefully, bring some of that EBITDA margin expansion into that Trader Interactive product. The actual deal itself takes Carsales net debt to EBITDA to about 2.7 times. They're hoping to get that down to about 2 times within 2 years. Obviously, strong free cash flow generation, so they'll be paying that down. Basically, a similar playbook to what they've done in South Korea with Encar. They basically bought a stake in that in 2014, got under the hood, brought some synergies across, like what they saw, and then bought out the rest of that business. That's grown at about a 20% revenue CAGR since about 2014. So management have definitely proven they can do this before. They're just rolling out the same playbook with Trader Interactive. So on the actual playbook itself, basically, Trader Interactive is yeah, as I was saying, a digitally immature product in the US in non-auto. So that's your RVs, power sports, commercial trucks and equipment. They have market-leading positions in RV. They're about 8 times larger than their nearest competitor in terms of audience, and about 5 times the nearest competitor in terms of motorsports. So dominant positions in a pretty large and growing total addressable market. And I think that's going to be a key structural growth driver for car sales going forward. Importantly, the non-auto US total addressable market is actually 16 times that of Australia's non-auto market, and even 2 times larger than its actual auto market. So, quite a large market for these guys to continue to grow into. Trader Interactive's only got about a 6% market share. That just highlights how immature that particular market is. So I'd expect car sales to actually ramp that up as they bring in across some of their products that they'll probably holding back until they got it 100% acquired, and that being, their dynamic pricing, their digital trade-ins and media advertising, which is really only a small part of Trader Interactive at the moment. So pretty good growth drivers from what I can tell. Added benefit of actually diversifying the car sales revenue base away from Australia, into the US. Obviously, they've got Korea, but as well as diversifying geographically, it actually diversifies away from their core product set of cars into non-auto. They've actually pretty much pre-reported at the raise, pretty tight guidance, 510 mil revenue, 270 mil EBITDA, and 196 mil NPAT. So no real surprise at the actual result. I believe it's just more about that outlook going forward, particularly in the US and Korea. Moving on to Seek, something I've spoken about a few times, but again, these guys have got pretty tight guidance in the market. Consensus is sitting at the upper bounds. Revenue at 1.1 billion, EBITDA 515, and NPAT 250. So I don't anticipate any real surprises at the update, given where the market is. Obviously, factoring some pretty strong growth in 22. But for me, the cyclical tailwinds are still in play here. We know a couple things. One, job ad volume growth is still very strong. It was strong in FY22. We can see that in the top right-hand chart there. That actually haven't fallen off the cliff, sitting at about 25 to 30% year on year. And number two, we know labour scarcity is still a factor, and still a factor at play here. Job vacancies at 480,000. That's in that bottom right-hand chart there. So those tailwinds are still in play, and they don't look like they're rolling off in any way, shape, or form in the near term. But for me, I guess the swing factor we Seek more specifically is twofold. Firstly, are they going to expect continued volume growth well into FY23? I don't think the market actually has that baked in. Consensus has about 5% revenue growth, which if I had to hazard a guess, I would say is mostly price related rather than growth related. And secondly, yield growth into FY23. So obviously their debt products are quite a big driver for these guys. They're looking to give them a push. And the rollout of that new price to value strategy, which is basically dynamic pricing. So is it a call center role in Adelaide versus a finance role in Sydney? They're actually pricing them different, and they'll vary depending on the market and demand from time to time. So they're going to use that to actually underpin that yield growth going forward. So basically what I'm trying to say is they have a price lever to pull if volume does drop off, and it's going to be interesting to see them hopefully talk to that at the 22 result and how that's going to wash through. So pecking order, it's almost like asking you who your favourite child is. You tell everyone you like them all, but you've really got a favourite. But in the short term, obviously REA, I've still got on a buy, still like it. Seek for those cyclical drivers, and Car, probably third short term, based on its recent strong share price rally. But longer term, it's hard to choose between Car and REA. Like them both, good structural drivers behind them. And then Seek probably on a longer term basis, as we expected employment conditions to normalise. Probably a ranked third there. Moving on to the smaller names real quick. Most of them have actually pre-reported. So it's going to be about FY23 outlook rather than backwards looking. Airtasker, obviously 190 mil GMV, 32 mil rev. We've had Tim come in and present quite a few times recently. He talked about the take rate dipping to 16.6%, whereas normally it's between sort of 17 and 17.5. Thankfully, that's since normalized after some of these sort of COVID initiatives have rolled off. The One Flair acquisition is expected to add about 35 mil GMV and above 6 mil rev into 23. So it's going to be all about, stripping out costs once they integrate that acquisition. Tim's pretty much focused on being operating cash flow positive at the group level by the end of FY23. So that's a positive. And international looks to be gaining traction still. So they've actually hit that international GMV run rate. They're aiming for 8 to 10. He's coming in probably closer to 10 with the UK really rolling strong. Obviously, US is very early days, but his talks are actually launching in LA this year, which should hopefully give Airtasker a bit more of a profile over there as they build out that marketplace. But still like Airtasker, and we're back in management here. And MoneyMe, again, well known to the network, so I won't have to spend too long on there. Again, they pre-reported to our FY22 rev, 138 mil. They're expecting at least 200 mil rev in FY23. Obviously, fintech has been a pretty brutal space of late. There's no bones about it. But these guys have sorted out their funding capacity. They have 380 mil of headroom. They've obviously started their term out, so the ABS issuances have begun, which should have the benefit of lowering their overall cost of funding. And AutoPay, that's growing rapidly. It's now 500 mil in gross receivables. That's from a standing start from April 21. So the business is growing. Asset quality obviously is going to be the key market focus here. They've held their net charge-offs pretty stable at about 3%. That's been stable for the last sort of 3 or 4 quarters. It'll be interesting to track over the next sort of quarter or two to see if any of these rate rises have actually impacted asset quality. But so far, it hasn't. They've managed to hold up quite well. They've proven they could do that over COVID when bad debts didn't sort of fall off a cliff. Obviously, they had to raid their provisioning at that time, but that's since kind of normalized as well. So still, I like the story. Obviously, it's been tough, but they're looking to actually moderate some of that strong growth they were having and focus on more on profitability. But I mean, that being said, they're still going to do at least 20 mil cash NPAT this year. So just to round it all out, quick summary. Obviously, happy with the 3 classified plays. It's just more about picking and choosing your entry points. I've still got REA on a buy. Still like it, as I mentioned. Seek's got those cyclical tailwinds. And Car's got that longer term structural growth. But yeah, it's all about finding the right moment to get in.